I was like, yeah, by all means, because sometimes I have questions myself.
Exactly. You may need to watch it again some other time. So yeah.
Exactly.
Because one of my partners, and she has a presentation coming up, so she asked me to do that. So anyway, this person, the first step in building your bank is we gotta capitalize it. We gotta have money in the bank, right? So
Right.
in this scenario, she's putting $10,000 a year for 7 years, and that's kind of what you see right here. Year 7, right? Oh, wrong pen. There you go. Year 7, right there. The last year she put 10,000. That's 70,000 a year. Now, is that a requirement? No. I have people that start banking literally year 1. People that start banking in year 3. We're going to make a proposal of $200,000 a year coming up after this meeting. She's putting $10,000. Well, actually, Turill had a proposal for somebody of big money about an hour ago. So, you know, it's very flexible. We have to respect certain IRS rules because obviously this is real, this is regulated. So as long as we don't break what is called the modified endowment contract rules, we're good. So in this scenario, she puts 10,000 for 7 years, and now she's going to start banking. So if you go to the right-hand side, I want you to notice these 2 columns, the gross cash value and the net cash value. You want me to make it bigger?
No, I was just moving down my thing. Yeah, that's perfect.
Okay. So your gross cash value and your net cash value. I want you to notice how she has $62,000 there to start doing something with the money, right? She's ready to go. And notice how those 2 columns are the same. Now look at what happens now. Now she's going to buy a car. And you see these 30,000. So now we're taking money out to go ahead and buy the car. So we have 30 grand, boom, the money's out. She walks into the dealership, she writes a check, 30,000, we're done. Now go to the right. You see how the net cash value goes down to $40,000, which makes sense because we just bought a car for 30 grand. But do you notice how the gross cash values now went up to 73?
Correct.
You see, so we don't pay you interest on the 42. We actually pay you interest and dividends on the 73. Now, how this is possible? Because this 30,000 is not her money, it's insurance company's money. You see, when you look at the hierarchy of money, the example that I always like to give is, you know, let's say you're going to open a restaurant. You have a local restaurant and you need some tomatoes. Well, you can go to your local Albertsons supermarket and buy tomatoes because you have a small restaurant. But if you have 10 restaurants, well, Albertsons gets kind of expensive. So now you want to go to maybe a local wholesaler so you can get a better deal because you're buying a lot of tomatoes. And if that you know restaurant becomes an international conglomerate, probably at that point you're raising your own tomatoes because it's cheaper for you to do so than actually buying from somebody. It's all about volume. We call that economies of scale. Money is exactly the same way. If you're going to get a mortgage, then you can go to your local bank. But if you're going to build a gigantic mall in Singapore, you're not going to borrow from your local branch. You're going to go to a wholesaler. So when you look at the hierarchy of money, we have tiers. So tier 1 capital, there's only 2 people that can offer tier 1 capital: the Federal Reserve and insurance companies. People don't realize that the largest money funds in the world are not mutual funds, are not commercial banks. The largest money funds in the world are insurance companies. So the reason why we partner with an insurance company here is because it gives us access to that tier 1 capital, which means it's the less expensive kind of capital that we have access to. So by having the money in partnership with the insurance company, now we get to use the insurance company's money instead of having to use our money, right? So the next question is, well, that sounds all great and dandy, but why in the world will the insurance company let me use their money? How does that work? Well, the reason why we can use their money is because just like when you get a mortgage, you're actually posting collateral. What is your collateral? Your ability to earn income, and that's what we call a death benefit. You see, most people think of life insurance like I'm buying term and somebody gets money when I die. And that's true. That's how some insurance work. But the kind of insurance that I'm talking to you about, Haywood, is the kind of insurance that you actually own. So notice here how we have 2 more columns, the gross death benefit and the net death benefit. So here, the client owns $1 million or so, 944 of death benefit. That is the death amount. If she dies, somebody gets 140,000. But unlike the traditional insurance thinking, or traditional insurance policy, she owns this money. And because she owns it, she can sell it, she can leverage it, she can do whatever she wants to. So do you notice how when she takes the $30,000 out, you see that we go from 975 to 944?
Mm-hmm.
If she dies right there, the insurance company will pay 975, I'm sorry. But then they say, oh, hold on, you owe me 30K. So we're gonna deduct the 30K, so your family only gets 944. Why is this so cool? Because now she's leveraging on money that she will never see. And she's posting a portion of that benefit as collateral. And in doing so, allows her money to continue to grow completely uninterrupted, completely unabated. Now look at what happens now. Do you see this 8,784 right here?
Mm-hmm.
That's her car payment with interest. In other words, if she would have gone to Toyota Credit and she has average credit score and she would have gotten a $30,000 loan for 4 years, her car payment would have been like $720 a month, roughly, a 5%.
Mm-hmm.
So like I told you in the presentation, like Turill told you, she's still going to have a car payment because it's coming from her bank. The difference is, though, that the $700 a month, instead of going to Toyota Credit, are going to go back now to herself. So that was going on right here. So 8,000, 8,000, and 8,000. It's a 4-year loan, right, in this scenario. She does for 4 years. Now notice how this is 23,000 instead of 8,000.
Mm-hmm.
Why? Because the way most people, the way most Americans buy the next car is they turn their car in. You know, you have an old car, you turn in, and you get a new one, right? Well, instead of turning the car in, what she's going to do is she's going to sell it. So she bought it for 30. Let's say she can get 15 for it in the market, and she just sells it. So 15 plus 8 is 23, and she pulls that back into her bank. And now she gets another car. And then 4 years later, she buys another car, and so on and so on. So if we use our imagination, Haywood, I want you to think of, okay, so let's think about the everyday person. We bought a car, we finance it, we turn it in, and then we make payments every time. If we just keep making payments every time, every 4 years for the next 40 years, so we bought 10 cars, right? And we just keep making payments. How much equity, how much money in cash will that person have after 40 years? What would you say? You're just making car payments every single month, every single year, forever, like most people do.
Nothing really. I mean, because
You're exactly
like
right.
lucky on a classic vehicle or something, but yeah.
Yeah, you end up with a 4-year-old car at the end and no cash, right? Because we've been transferring, and that's the key word, wealth transfer. We've been transferring our wealth every time we make a payment. Now check this out. I want you to remember 2 numbers. How much did she invested in her bank? How much did she capitalize her bank with? 70K. That's all the money she put in. From that point on, we took 30, we paid it back. We took 30, we paid it back with interest, and we just went back and forth. But her actual investment was only 70,000. And then she bought 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 vehicles. So check this out. At age 73, she paid off her last car. She's not going to drive anymore. Okay? So now she has an asset that is making interest for her worth 1.4 million. So her capital investment of 70,000 became a capital foundation, an asset base of 1.4 million with 940,000 in cash to do whatever she wants to do with it.
Now, quick question.
Yes.
So she's making payments. So is she still injecting her 10,000 per year?
No, she's putting the money somewhere else to grow something else.
So after she got to year 7 and she put the 70,000 in there, what does she continue to put into the bank to continue to build
her car payment? She's just taking money and paying it back, taking money and paying it back. But because her principal never went down, she continues to make money on an ever increasing principal, right? She continues to earn interest uninterrupted, and that's where this 1.4 million comes. So in other words, the opportunity cost, the cost of she not capturing those dollars, if she was to do what everyday people do and just pay the car out of pocket, right? You said it yourself, you end up with 0. The opportunity cost is worth 1.4 million.
Right.
right?
Right.
So what I was telling you the other day is somebody's going to make the 1.4 million or more. It's going to happen. But the question is, who's going to make it? Toyota, Bank of America, or you, Mr. Klein? Because when we transfer the wealth, again, the bank is not going to lend their money. They're going to take your money to lend to the next person. And then when the next person has a car payment, it goes back to the next person. And you see how they're multiplying the same dollar over and over again. So they're going to end up with more money, obviously, than you, because you're going to end up with zero. Or you can become your own financial institution, so to speak, and your own financing source, and you end up with an asset worth 1.4 million with about $1 million almost in cash, just from her car payments. And you're right, and that's the key. Now she has 10 after 7 years. Now she has an extra 10,000 from her savings. Maybe she wants to do another one. Maybe she wants to put money in her Roth IRA. Doesn't matter. But the cool thing about this, Haywood, is that this is just one car. What about if we do this with her and her husband? Now that's 2.8 million with about $1.8 million in cash. Isn't that crazy?
That is crazy.
And that's my point.
I was thinking she had to continue to put the 10,000 plus her car note. And after that, after she put her 7 years in to equate to the 70,000 and she gets her first loan for 30,000, the only thing she's basically responsible for is paying back the loan amount monthly.
No, she only put in, she only capitalized her bank with 70K. Everything from that point on is taking money out and put it back in. It's the same money circulating over and over again. So if you look at these two columns, what you'll see is, we go 71, 82, 94, 122, boom, 105. 118, 132, and then it goes down because we're taking money out. But do you see how this other column never goes down? 125, 139, 153, 170. And when she takes money, it goes from 170 to 186. And so on, and so on, and so on. This is the one that matters because this is the one making money. Think of it like it's the same phenomena, Haywood, as owning a house. If you own the house and you rent it, the cash flow is yours, right? This is your house. Is the equity of the property in any way related to the amount of money you get on the rental?
No.
No. Exactly. So it's the same principle. The value of her asset, the gross cash value, has nothing to do with how much money she takes out or how much money she doesn't take out. It doesn't matter. And that's the whole point. We're conserving and keeping her capital untouched, protected. Most of it is guaranteed. It's backed by US Treasuries. So we almost guarantee she's going to have all of her money when she hits retirement. And again, this is not a retirement account. This is just her car payment. And she ends up with about $1 million. But there's more. Let me finish this part. So now she has $1 million. Now she's 74. Okay, well, like I said, it's not her retirement plan, but we do have $1 million in her. So let's give her $60,000 every year for her to just spend. Now, the cool thing is because this money is growing inside of a life insurance contract, there is no capital gains, no state income tax due, and no federal income tax due. So this 60,000, she actually gets to spend the 60,000. Now we're going to pay her $60,000 all the way to age 96. So at age 96, she dies. Her gross cash value, the size of her asset, again, how much did she invest? 70,000. Is $4 million. That's the size of her gross cash value. Now she only has 100,000 left because we're drawing all the income out. She dies, somebody still gets 500,000. So the 70,000 that she put in, and then all she did was to circulate her car payments through her own bank, she ends up with equity of $4.5 million from the 70K. That's really opportunity cost. See that?
I do.
It's a huge amount of money. It's serious money. But because we never make the math, we never think about it. Okay, if I buy that coffee today and I could have made 5% for the rest of my life, how much would I have? And again, this is just the car. Think about using this to pay your rent, like Turill said, your car, your kids' college education, your vacation, buy a business, buy property, and so on and so on. Do you know what has to happen? That $4 million become 5, 6, 9, 10. That capital foundation never goes away. So I don't need to make you 20% in the market, because 5% of 10 million is way, way more than 20% on 100,000. And that's the problem. People are playing with small money. By we allowing us to build that capital base and not get rid of it, then I don't need to make 20% for you to make a living. So I can have more guaranteed dollars. I can create more certainty in my client's account. And yes, I can have investments, but I'm okay when the market drops 50%. If I have $1 million asset, then I don't care. I can wait it out because I have the money, which most people cannot. Most people, when they lose money in the market, they lock in the losses because they get freaked out. They cannot afford to lose. But think about an investor. If I have a $1 million whatever asset here, can I take 400,000 to risk in the market? And if something happens, I'm still making money on the money? Yeah, that will be a savvy strategy. And that's exactly what hedge funds do. They never invest with their money. They call it margin. When you see those guys that pull a trade and they make like $1 billion on it, that wasn't their capital. They're using a bank loan to be able to fund the trade and then go make the money. The challenge of doing it that way, though, is that when the trade goes the other way, now you're bankrupt. But here, you cannot, because you own the capital, even though we're using the insurance company's money. Questions, comments on that?
Is there any requirement as far as what the investment time horizon must be for the consumer? Or is it something that a person who's 45 who wants to do it until they're 65, is it just a different, I guess, reward payout? And is that something someone can still do? And
yeah,
still have life coverage and so forth? Obviously, I know that they won't get the amount of capital gain as someone who, you know, obviously has 30 years as a younger person to do it. However, I didn't know what the basic time window was as far as, you know, it's a good idea to do it if you're 38, if you're 44, you know, how does that work?
That's a good question. And the real answer is that it matters, but it doesn't matter. Because just because you're 45 or 65, doesn't matter that you're not financing things. Again, go back to the presentation. Everything we do is finance. So just because we're retired, we're still financing things. You're still going to have to change your refrigerator. You're still going to have to upgrade your kitchen. So we're still financing things. So the age is a factor, but not a factor in the sense of the concept, right? And also what happens with older people, and I'll show you the kind of the case that Turill, I think, was going to propose the other day, where they're advancing a bunch of money. So you get the person, usually what happens with older people is that they have assets. So in her case, she's in her 20s, so maybe 10,000 a year, that's all she can afford, right? Because she's 26. But now you're talking to the 45, 50-year-old guy, and he's sitting in 100, 200,000 in a savings account, or he has a stock account with 90, 100,000, and they want to start banking. Well, check this out. So we have the ability, without breaking the tax rules, to actually put money up front and then continue to fund it on a regular basis. So this guy is going to be putting, hopefully, $2,000 a month, right? But he's going to deposit a lump sum of 200,000. So whereas my girl example, it took her like 15 years to get to 200,000. This guy is going to have 200,000 literally the year one, literally right there. So he can start banking that year. He wants, if he takes the money hits the account. He calls 3 days later, he can get his first policy loan and use insurance company's money. So you need 3 things, Haywood, to wrap this up to make this work. This is not something that they can buy off the shelf. And this is really important because here's where your value comes, right? This is not something they can, walk into farmer's agency and just buy from whoever. Most agents don't understand any of this. So it's a bit, it's an involved process, let's just say. So you need 3 things to make this work. First, you need to have something called participating whole life. It cannot be term, it cannot be universal life. It cannot be any kind of whole life. It has to be participating whole life. And I'll tell you what that means in a second. And in the United States, only, which is takes us to number 2, only mutual companies can issue participating whole life. So there's 2 types of insurance companies in the country: mutual companies and stock companies. So when you have a stock company, who owns the company? The shareholders, right? People who own the stock. So all the profits of the company kind of flow upwards, because these guys are the ones that need to make the dividend. They are the ones who make money. In a mutual company, we don't have shareholders. So all the profits need to go back to the owners of the company, which in a mutual setup are the policy holders. So you see, in a mutual setup, the client that has this contract, this policy, like the girl, she's a mini owner of the company. So all the profits need to go back to her, and that's what equals dividends. So participating means that the client is the one that gets all the profits, gets all the dividends, all the mortality, all the expense savings. We'll talk about how does a dividend work, later in your training. But the point is that all the profits go back to her. So you can use Prudential, you can use Farmers, you cannot use State Farm, you cannot use Boya. It has to be a mutual company. Ohio National, Lafayette Life, New York Life. There's only a handful of companies that can do this. And there is one last thing that is even more important than those 2. You need something called non-recognition loans or lending. Do you see how she takes 30,000 and her gross actually goes up? So we pay the same dividend whether she takes money out or not. That is what non-recognition lending means. Non-direct, my bad. Non-direct recognition. It's getting late, I guess. That's what non-direct recognition is. Only 5 companies in the United States, as far as I'm aware of, that offer non-direct recognition. It's a very unique opportunity for clients. So again, Farmers won't work, Prudential won't work, MedLife won't work. So that puts you in a position where you have a competitive edge, because we always want to look better than they do, because we don't have to share the profits. All the returns go back to the client. That's why it looks so like crazy. You have ended up with 1.4 million. Why? Because all the charges, all the money insurance companies make, they cannot keep it. It has to go back to the client. Make sense?
Mm-hmm.
Right? So this is the space this is where we fit. Because we can bring a unique value proposition to the client that they cannot get anywhere else or in very few places, right? And that's the advantage. So you need those 3 things to make this work. So if we have those 3 things, the client understands the concept, then like this guy, he puts 200,000, literally, he can access his money right away, buy property, finance a motorcycle, whatever he wants, and then start paying it back. It's up to him. Questions, comments on that?
Nope, got that one clear.
Last point. All this is regulated by the IRC code 7702, section A, and IRC code 101, section A and section C. We call this the modified endowment contract rules. All this is legal. All this is, allowed. And I forgot to mention that 1.4, those $4 million are 100% tax-free. She never paid a dime in income tax or capital gain tax and all that money, as long as she was alive, just like the wealthy do. So tax strategies, tax planning, financing, cash flow management, retirement planning. This is kind of what we do. So I just wanted to give you the breakdown so you kind of know what's going on and why we're doing it. But as you go through your training, you're going to learn all the ins and outs. We really get into the weeds, as in the weeds, right? We deconstruct this. And again, what I want you guys is to challenge me. Think about it, process it. Yeah, this also makes sense. And we go over again and again until you guys capture the essence of how unique this is. And to wrap this up, how does this help people? Well, think about that client that is having a car payment and has to do all this stuff, and they end up with no money. You see how $1 million can change their lives? In a massive way, and again, once the client gets it, they're like, Django, well, can I have a system of policies? Yeah, that's the idea, because she put 70,000 and you hit the nail on the head, I'm sorry. She has 10,000 to put somewhere else. so she could have another one or do something else with the money and have even more growth, and so on and so on. All right. Anything else on that, Turill? Does that make sense?
Very much so. Very thorough, in depth. It was great.
I think for now that's good. Right?
Yes, good starting.
So what I would like to leave you with today, Haywood, is the confidence that you're gonna have solutions that actually help real people to build real wealth. Because again, I don't know the numbers in North Carolina or South Carolina, but in California, the average 50-year-old has less than $10,000 in their 401k plan. And
Not the
she's
same here, I'm sure.
and it's probably similar across the country. And this person, just by buying her cars, spending money she was going to spend anyway, she ends up with $1 million. And again, that's just one car payment. So go ahead, Turill.
Hey, put my cell phone number in the chat, so you could go ahead and get that and text me. That way we could have each other's information.
Okay. All right. We'll
All right. So as soon as you can, shoot me that email. Well, let me stop recording.